Hey traders, just wanted to do another static video on some education, maybe refined from what I've done in the past, but this essentially is cake baking, alright, the cake baking static video, alright, where I go into, why am I taking a trade somewhere, like what makes a trade set up strong or weak or stupid, right? Where it just doesn't even make sense at all. All right. So let's get into it. In cake baking, we have the mixing bowl. We start with the mixing bowl. But what is this if we're talking about an analogy for trading? The mixing bowl itself could be what we consider the trend, right? The overall trend. And we're talking about zoom out. You have to scale out and really see, because we can get some ebbs and flows in between the overall trend. But like Target, perfect example. Like overall, since its inception, you go to the daily, you can go all the way back. And you can see like $25 in 2008. All right, it's overall been making higher lows, higher highs throughout its history, right? So the mixing bowl, overall bullish. All right, so we'd be looking in a bullish mixing bowl for maybe bullish patterns to trade, right? Because it's true. I mean, you don't want to fight the trend, right? The trend is your friend, so bullish patterns and overall bullish trends are going to be more reliable, and they're often going to outperform, right? But a bearish pattern, a bullish trend might underperform, and or it might just fail completely. All right, so the mixing bowl, the starting point for our cake baking. All right, but we've got ingredients that have to go into this mixing bowl: flour, sugar, eggs, butter, oil, and maybe even baking powder, right? And so this goes into the philosophy I use for trading, and that is coinciding variables, right? Cake baking also has coinciding variables. You can't have a cake with just one ingredient or two ingredients. You preferably want to have as many ingredients as possible, or just the adequate amount. So let's just talk about, what is the flour? I think the flour could be divergence, right? Bullish divergence, or okay. So let's just do it like this. This is like improv, all right? So I'm writing this down. Divergence is the flour. So what is bullish divergence? Bullish divergence or bearish divergence is a form of market participant exhaustion, whichever way you look at it. All right. So if we look at this target example, perfect example of seller exhaustion, right? Where you made three discernible valleys, one each lower than the other, except arguable, candle closed a little higher on the last one. But so like, look at the selling was very intense, and then it started, getting less intense. The selling impulses were just less and less than before. And so each time you made a lower low on those prices, right, you made lower levels of the negative momentum, right? So that is a form of bullish divergence. On the RSI, the same thing. So you had two different oscillators that were showing this form of divergence, or it was giving you your flour. All right, flour is important. It's, if you can have flour, you have to have flour. You don't have to have flour, I guess, in the trading sense, and maybe that just is me being bad at making analogies and stuff. But I would try to have divergence, whether it's hidden or classic, at all times for a trade setup, right? It's really important. Okay, so the next ingredient would be sugar, which the sugar could be critical support, right? Hitting critical supports, looking left. You always want to have that, right? Sugar in your cake makes it sweet. Holding critical supports, looking left. September of 2018 high. July 9th, 2019. These are previous all-time highs at one point. So at this support, we showed the bullish divergence. Oh my goodness. All right, coinciding variables. So we've got our flour here. We've got our sugar. So we need to throw in some eggs. What could the eggs be? Maybe a potential pattern. a Bulkowski pattern, a descending broadening wedge where you have two diverging trend lines, which they very well can be bullish reversals, which in this situation it turned out to be so. You had some chop, man, on the breakout. You know, that's the macro. Welcome to volatility. But yeah, I mean, you would think that eggs would be a pattern, whether it's a triangle, a descending broadening wedge, a right angled and descending broadening formation, a diamond pattern, whatever it is. You oftentimes in your mixing bowl, it's great to have a pattern. So the next thing would be implementing some butter or oil, right? What could that be? Well, I think what the butter oil could be for this analogy is time scale hopping, right? So we're on the 4 hour right now, and we're showing great variables, right? So you've got one variable on the MACD bullish divergence. You've got two variables with the RSI bullish divergence. You've got three variables with the Bulkowski pattern. You've got four variables with the critical support touched. And then implementing our butter and oil, we could go to the daily to see that we have even more ingredients. Now we can implement our oil and butter because we don't just have a somewhat significant time scale implying a reversal to the upside. You now have a quite significant time scale implying a reversal to the upside because of the seller exhaustion, which is the divergence. So now from so we had four ingredients that were already in our mixing bowl. Now we're throwing five in, where the MACD is showing that divergence, right? That's five. Then the RSI, 6 coinciding variables. So we time scale hopped. We've implemented our butter and oil. And you know, the baking powder could be more, right? I don't really know what baking powder. You know, it could be a harmonic pattern or something. But I think that, you know, if we're going to talk about harmonics, we would want to keep it simple and keep that as our eggs, right? The pattern, because a harmonic is a complex pattern. So I would say the baking powder could be Fibonacci retraces, right, from previous lows. And I think our discernible low, right, from this rally is down here from December 2018. We had that first crack. Whew, we had a lot of volatility. The Fed, you know, sedated that volatility, and we ran up one more time before the big crash. So let's make our baking powder Fibonacci, major Fibonacci retraces, where we know, if you look at, you can watch my Fibonacci video if you want to learn more about it. But was this not within the parameters of the golden zone between the 618 and the 382, 38% retrace? It was. And so we use our critical thinking to say, all right, we're inside the golden zone. You know, this is where a reversal could occur at any time. And then you look at the oscillators, the supports, and realize, okay, so this is possible value areas. People might perceive value. Oh, there's a 58% sale on target. That's what Fibonacci is, low to high, 58% sale. Right? You go to your grocery store. Dang, dude, 58% sale on freaking these eggs. Just kidding, but it's really 58% sale on target itself. So there you go. Flour being divergence, sugar being critical support resistances, eggs being the pattern, whether it's Bulkowski or harmonics. Butter/oil would be your time scale hopping, getting multiple time scales implying the same thing, which is just what we looked at. And the baking powder being Fibonacci retraces, where we know about value. So we put it to the test. Sure. Let's do it real quick. That was literally the process I used to enter this trade and to post it for patrons in the unofficial setups category, right? Where you had everything you could ever want, right? This was the second bottom, not even the third. Stop loss was below the critical support resistance, right? And there you go. We hit it one more time, got the entry, hit the support once more, got, you know, I mean, we had the triple divergence. First target hit, second target hit, And the third target eventually hit. You even got to the 88% retrace from the high to the crash low. So let's think about, let's continue on with this analogy of cake baking, where, all right, man, we've got our bowl of ingredients. They're all raw though, right? You don't want to, I mean, they're just, nothing works until you put it in the oven. But what is the oven? The oven itself is the process of the trade. And also, before even putting these ingredients in the oven, you must measure, right? And so I believe measuring the ingredients before you put them in the measure, in the bowl, is practicing good risk to reward and position sizing, right? Where reward to risk, real quick, 3.48 to 1 reward to risk. If I have a 3 to 1 reward to risk ratio on my trades, I only have to win 33% of them. If I have a 2 to 1 reward to risk, well, I have to win half my trades. I would prefer, I mean, look, TA is inexact and failure is a part of it. It is, just consider it part of your overhead, just like the restaurant owner would have to consider the overhead in his business, like paying his employees, food costs, vendor costs, right? Services. So reward to risk is part of measuring your ingredients. And then we talk about position sizing, where you don't want to be inconsistent in your position sizing, because, if you go all in, you put in 20% of your portfolio in a trade that fails. Well, man, how many trades is it going to take for you to recover those losses when you are practicing good position sizing, or the way you should, right? Where it's like 2 to 5% of your portfolio, of your trading portfolio, right? It'll take multiple trades to make up for those losses. So that's very important. Trading is not this YOLO Wall Street bets crap, man. It's really kind of boring. It can be boring if you don't have a passion for it and you don't understand these concepts. Okay, so we talked about the mixing bowl. Now the oven itself is taking the trade, right? Obviously, when you take the trade, or when you put these ingredients that you've measured into the oven, you turn it on. Sometimes it's going to take longer to cook. This cake might be 400 degrees for however long versus another cake that might take longer. And when you use time scales like the daily, then it would take longer. I mean, because the more significant the time scale, the longer it may take for the pattern or trade to play out. All right, so the 4 hour, we ended up getting, that it was almost identical divergence on the daily and 4 hour, but you got a real nice rally initially because of that 4 hour, but the daily helped propel this to the second, third targets. So it's always really good, man. I mean, I really think you want to have the daily on your side, or maybe even the weekly if you're lucky enough. But that's just not always going to happen. Think about the stars aligning when the 4 hour, the daily, and the weekly all at the same time are implying a reversal to the upside. One would see that and be cognizant of the weekly and daily, but one would take their trade on the 4 hour chart. Does that make sense? Because the daily and the weekly are probably already showing that before the 4 hour. And once that 4 hour matures and shows the divergence and stuff, the things we're looking for, that's when one might pull the trigger on putting the cake in the oven. Because once it shows on the 4 hour, maybe it's the preheating session of the oven baking, or the oven, is over, right? And it's like beep beep, it's hot enough, it's time to go. All right. So you put the cake in, and it might take a while, depending on time scales. All right. And so when you pull the cake out, sometimes it could be ruined because the trade fails, and that's okay. That's why we practice good reward to risk and position sizing. But in the target situation here, we pulled the cake out, and it was wonderful, dude. It tasted so good. Insulin spiked in our bodies, and it kicked us out of ketosis. Man. And that's just how it goes. All right. So that was, again, it's been like the first time in a year I've done a static video kind of on education like this, at least for, non-patrons and stuff. So I just want this to be public. I want people to know. Spread this video. Please leave a comment in the section below if you enjoyed it. You want me to do more of these. Just let me know, man. All right? So thanks so much for listening to me for this 15 minutes, sorry. So I'll be live later, most likely. Till next time, respect the T.